Hello, everyone. Tyler Ford, Tucson, Arizona with eXp Realty, and welcome to Living in Tucson, your Tucson real estate connection. And in this live, the question is lowering rates the answer? And I know a lot of people out there are wanting the feds to put the brakes on and lower rates, but is that really the answer? I would argue no, and I'm going to show you why. So we're going to take a look at some news items and point you in the right direction in terms of asking some right questions, and then also go over some local real estate market stats. So again, is lowering rates the right answer? And again, I would argue no. And as everybody knows, rates have dramatically increased. It's been the steepest rate hike by the feds in the history, and I'm going to show you a chart to back that up. But the other big thing that's happened as a result of the feds increasing rates, it's really put a situation to where there's not a lot of inventory to be had because sellers are what are called rate locked. They're locked into these low rates that are in the 2%, low 3% range. And it doesn't make any sense for a seller to sell a home, to buy a more expensive home at a rate that's more than double. So selling a home and buying another one has gotten extremely expensive. So people are staying put. Therefore, there's just not a lot of inventory to be had. And as a result, what's happening is unit closed sales have dropped off by more than half. There's not a lot of activity out there. The people that are buying or selling are the ones that have to, whether it's a divorce situation, a death, a marriage, children. There's still buyers and sellers out there, but it's limited to the people that really have to. And then there's also the other market that's the cash market that just is less sensitive in terms of rates and price. But I'm going to share my screen and show you some things and point you in the right direction here. So the first thing I want to show you is this is a chart that just shows you what the feds have done from 2022 to 23, which is this yellow line right here. And it's been the steepest, most aggressive Federal Reserve rate hike in terms of the Fed funds rate. And you can see these various lines, but the slope and the speed and the amount that they raised rates, again, has been the most it's been the steepest and again the most aggressive that we've seen in the history of the feds. And so from 2022 to 2023, a total of 4.88 in terms of the rate increase in terms of the Fed funds. And you can see if you look right here, it breaks down the time period and then how long the feds raised rates and by what amount. So from March of 2022, May of 2023, 14-month period, the feds increased rates by 4.88%, again, which is the most aggressive if you compare rates in terms of what the feds have done. And again, this chart shows it all. And as a result, some things are going on here. One of the things that we look at are mortgage applications, which is a pretty good indication in terms of people that are getting ready to buy a home. So there is the mortgage industry gives us information in terms of how many people applied for a mortgage. And if you look here, it's the lowest it's been in the history in terms of as the interest rates have gone up, mortgage applications have gone down to almost a 30-year low. And then if you look at refinances in terms of people refining, pulling money out, this is at an all-time low, and refis have pretty much dried up. So right now, the mortgage industry and lenders are really struggling just because there's not a lot of volume to be had. And then this right here, I would encourage you, and I watched this video in full. It's 20 minutes long. It's worth watching. But worse than a stark market crash, what would happen if the Feds cut interest rates? And again, if you go to YouTube and just put that in there, you're going to find this interview and it's worth watching. But if the Feds were to lower rates, it would be a reverse market crash where things would get out of hand, home values would continue to go up, and it would not be a good thing for the overall housing industry and for the economy as a whole. But home values would continue to go up, and it would create all sorts of problems because, as of the last couple of years since COVID hit, it's been a real challenge for first-time home buyers and also for people buying on an FHA or a VA loan because they've been having to compete with cash buyers and people buying on a conventional. And it's been a real challenge. And if Feds were to lower rates, it would put them again in the same position to where people would come back into the market. You would have your cash buyers and buyers that are buying conventional with large down payments. And again, it would really create an issue for first-time home buyers and people buying on an FHA or a VA loan. So again, I would encourage you to watch this video. It's definitely worth the watch and explains it in detail that if the Feds were to lower rates. But the best thing the Feds can do right now is just to put the brakes on, but go sideways. And it would create less volatility and stay in a range in the high sixes to mid sevens, which would be a healthy thing for this market. Stabilize things, home values would go sideways, and it would just create some stability within this market. So definitely worth watching. Now I'm going to jump over and give you some insight in terms of what's going on here in the Tucson housing market. Let's see here. So in the Tucson housing market, this is what we call the market action index, and it's a gauge that kind of gives you a temperature reading of what's going on with the market. But the bigger the number, the hotter the market, more of a seller's market. And when the market was super hot, this index was in the 80s and 90s. It's when sellers were getting multiple offers above list price. Cash buyers were definitely in the driver's seat. People buying on an FHA, VA were at a huge disadvantage. Well, the market's definitely cooled off as a result of interest rates going up and the buyer pool being drastically reduced because of home affordability. And I'm going to put a link down in the show notes, and I would encourage you to watch the video I did on the affordability index. It's worth the watch. But right now, the affordability index is as low as it's been. It's an inverse relationship, meaning home ownership is more expensive than it's ever been, which is dramatically reducing buyers out there and demand. So right now, this market is dramatically slowed down. Closed sales are off by about half and has everything to do with a rising interest rate environment and home affordability. So go watch the video on a home affordability. But yeah, the market action index definitely starting to cool off. As you can see, we were as high as 85. Now we're sitting at 45. So we're entering more into a neutral balanced market. Buyers right now are able to get seller concessions, negotiate price. Homes are sitting on the market a little bit longer. So things are definitely starting to cool off. If you look at one thing to pay attention to is the average days on market. And in my opinion, what I think is going to happen is home values are going to go sideways, but it's going to take longer for sellers to sell. And we're going to see average days on market start to go up. And again, just my opinion, my gut feeling that we're going to see homes start to sit on the market a little bit longer. And then also you're going to see people that have priced their home incorrectly. As a seller out there, it's so important to price your home correctly. But if you look, properties with price decreases, we're starting to see, let's see here. So this is a pretty good idea of right now we're starting to see homes with price decreases start to go up because days on market start slightly going up. Therefore, people are having to adjust their price slightly. So, something to pay attention to is days on market going up, and then people that are going to start to do price reductions in order to get their home sold. The other thing to look at, I'm not going to go through everything, is just inventory levels. They still remain low, but they're starting to tick up slightly. And again, due to interest rates going up, people being house locked, in my opinion, going back to, is lowering rates the answer? I say no. Going sideways and within a range, I think, is the healthy thing for this market. Uh, the one thing, supply and demand, economics 101, the catalyst that would drastically change this market and really start to lower prices, a huge increase in inventory. And as of right now, I'm just not seeing it. But again, I could be wrong, but just something to take a look at. And then the other thing, let's go to the median list price has gone down slightly. The median list price, the high was 463. Now we're sitting at 439. So we're off slightly. And then if you look here, I get this question all the time. The market's different based on various price ranges. So if you look at the median price of 800,000, you can look at new listings and then how many of those new listings got absorbed. So there were 37 listings this last week, of which 22 of them got absorbed. It took 49 days on market in order to go under contract. And if you go to the bottom at 297, you're going to have more listings. And then the absorption rate was 47 of the 66 went under contract for an average days on market of 28. So that is it in terms of what I'm going to share. But each and every week, I'm going to log in, do a live, give you an update on some news, what's going on in the market, and then give you an update on what's going on here in the local Tucson housing market. So if you have any questions, comment below. And again, I'm going to put some links in the show note for you to take a look at. In the meantime, make it a great day.